On the surface, this looks like a familiar story. Oil prices rise, gas gets more expensive, people complain at the pump, and eventually prices come back down. But this time, the shock didn't come from a supply glut or a slow-moving cartel decision. It came from a war. In February 2026, a single military escalation shut one of the most important shipping lanes on Earth, and within weeks, oil prices had jumped by nearly 40%. Since then, the story hasn't ended cleanly. Prices spiked. They fell. They spiked again. And now, in August 2026, crude is trading in the high 70s to high 80s, not at crisis levels, but not calm either. The question isn't whether this shock happened. It's whether the American economy has quietly become something different than it was the last time oil prices spiked like this. Visual, slow aerial shot over a strait filled with anchored tankers, dissolving into a gas station price sign. 2. What just happened? Here are the plain facts. On February 28, 2026, Israeli and American strikes on Iran triggered a rapid military escalation. In response, the Strait of Hormuz, the narrow waterway through which roughly a fifth of the world's oil supply normally passes, was effectively closed. Oil prices, which had been trading around $65 a barrel in late February, surged. By April 2026, Brent crude touched an intraday high above $120 a barrel. On June 18, 2026, the United States and Iran signed a memorandum of understanding to end the conflict and reopen the strait. Prices fell sharply. Brent averaged $85 in June and dropped below $70 by early July. Then came a second wave. In July, Houthi militants in Yemen attacked Saudi oil tankers and struck Saudi Aramco's Jazan refinery. Kazakhstan suspended crude exports following drone attacks. Iran rejected renewed direct negotiations with Washington, citing what it called violations of the interim agreement. Brent briefly surged back above $100, and WTI spiked past $90. As of early August 2026, WTI is trading around $78 to $80 a barrel, and Brent around $87 to $88. Both still elevated compared to where they started the year, and both still highly sensitive to the next headline out of the Gulf. Visual timeline graphic. Feb 28 strikes, April peak, June 18th, MOU, July renewed attacks, August stabilization. 3. The backstory. To understand why this matters beyond the headlines, you need the chain of events. It starts with a decades-old vulnerability, the Strait of Hormuz. A narrow channel between Iran and Oman, it has functioned for half a century as one of the world's single points of failure for energy supply. The corridor through which oil from Saudi Arabia, the UAE, Kuwait, and Iraq reaches the rest of the world. When conflict closed that corridor in February 2026, it wasn't just an Iran story. It was a global supply story. Every economy that imports oil, which is most of them, felt the shock simultaneously. The June ceasefire and reopening of the strait should have ended the crisis, and for about 2 weeks it looked like it had. But the underlying tensions in the region hadn't actually been resolved. They had only paused. Attacks on tankers, a major refinery strike, and export disruptions elsewhere in the world reignited the same fear that drove the original spike. That oil supply through the Gulf is not reliable, war or no war. A, B, C, D. A regional military conflict closed a global choke point. Prices spiked toward $120. Diplomacy reopened the strait and prices fell. Renewed attacks brought the fear right back, without fully repeating the original shock. Visual. Map graphic showing the Strait of Hormuz and surrounding conflict points. 4. The players. Iran and the broader web of regional actors, including Houthi forces in Yemen, hold leverage over global energy markets simply by being able to threaten the Strait of Hormuz. Whether or not full-scale conflict resumes, the credible threat alone keeps a risk premium built into the price of oil. Saudi Arabia and Gulf producers want stability and high enough prices to fund their economies, but not so much volatility that it triggers a global recession and destroys demand for their product. Saudi Aramco's own refinery being struck in July put the kingdom directly in the line of fire, not just as a producer but as a target. OPEC Plus is trying to manage the balance between supply and price. The group announced a production increase of 188,000 barrels per day starting in August 2026, a signal that producers believe they can absorb more output without triggering a price collapse, even amid the volatility. The Federal Reserve, now under its new chair, Kevin Warsh, faces a genuinely difficult position. Oil shocks create a problem central banks can't fully solve. Higher energy prices push inflation up, while also acting like a tax on consumers that slows growth. Raising interest rates to fight the inflation risks, choking off growth even further, but doing nothing risks letting inflation expectations become unanchored. American consumers, and lower-income households in particular, carry the most direct exposure. Research from RBC Economics has estimated that for every $10 increase in oil prices, gasoline rises by roughly 30 cents a gallon, and the bottom 60% of income earners devote close to 4% of their take-home pay to gasoline, a far larger share than higher earners. American oil-producing states and companies are the one group that can benefit. Higher prices mean higher revenue for domestic producers, and some economists note that job gains in these states can partly offset losses elsewhere in the country. Visual: global map highlighting Iran, Saudi Arabia, Yemen, Washington, D.C., and major U.S. oil-producing states. 5. The hidden force. Here is the deeper force behind this story. The U.S. economy is less vulnerable to oil shocks than it used to be. But less vulnerable is not the same as immune. Research from the Federal Reserve Bank of Boston shows that the American economy consumed nearly 1 barrel of oil for every $1,000 of economic output through most of the 1970s. That ratio has fallen dramatically since then, thanks to more fuel-efficient vehicles, a more service-oriented economy, and the rise of electric vehicles and renewable energy. That's why, so far, this shock has not produced anything close to the damage of the 1979-80 oil crisis. Modeling from the Federal Reserve Bank of Chicago estimates this shock could shave somewhere between 0.81 and 1.66 percentage points off 2026 economic growth, a real but contained hit, followed by a partial rebound in 2027 as the economy reverts toward trend. But the hidden risk isn't the shock itself. Its duration. A survey from the Federal Reserve Bank of Atlanta found that businesses see relatively moderate effects if elevated prices are temporary. But when firms were asked to imagine oil sustained at $130 a barrel through the end of 2026, about half reported that would cause a moderate to significant increase in their costs. The economy has become more resilient to short shocks. It has not become immune to long ones. Visual: chart showing declining U.S. oil intensity per dollar of GDP over decades. 6. The money trail. Who is paying? American consumers at the pump and businesses across transportation, shipping, and manufacturing that depend on fuel and refined products. Who is receiving? Oil-producing nations and companies, both domestic and international, along with refiners who can pass costs downstream. Who benefits? U.S. oil and gas producers, energy sector equities, and, over a longer horizon, the clean energy and electric vehicle industries, which have reportedly seen increased consumer interest as gasoline costs climb. Who carries the risk? Lower-income households, whose spending power is disproportionately squeezed. The Federal Reserve, which faces a policy dilemma with no clean solution, and businesses in transportation-heavy sectors, which have already reported declining demand, including notable drops in SUV and truck sales, alongside a rise in interest in hybrids and EVs, and a pullback in domestic flight bookings in favor of regional travel. Inflation data reflects the strain directly. The Fed's preferred inflation gauge, the PCE price index, jumped from an annual rate of 2.9% in February 2026 to 3.8% in April, a jump driven substantially by energy prices. Visual, flow chart, oil price rise, gas prices, consumer spending, sector impacts. 7. The second-order effects. If elevated, volatile oil prices continue, here's what plausibly follows. For the Federal Reserve, continued pressure to balance inflation control against growth support, complicated by the fact that rate changes can't fix a geopolitical supply problem. Analysts widely expect the Fed to stay in a cautious, reactive posture rather than making dramatic moves in either direction. For consumers, persistent pressure on discretionary spending, especially for lower-income households, potentially deepening what some economists have described as a two-speed economy, resilient at the top, strained at the bottom. For businesses, continued shifts away from fuel-intensive spending, visible already in vehicle purchase patterns and travel behavior, alongside accelerating investment in energy efficiency and alternatives. For energy markets, OPEC+ decision to increase production suggests confidence that supply can be managed even amid volatility, but that confidence could be tested quickly if Gulf tensions escalate again, particularly around further attacks near the Strait of Hormuz. For U.S. energy policy, renewed urgency across both parties around reducing dependence on a single volatile choke point, whether through domestic production, strategic reserves, or continued investment in alternative energy sources. Visual, branching diagram of policy, consumer, business, and energy market pathways. 8. What most people are missing. First, most coverage frames this as a story about whether oil prices will keep rising. The more important question is about duration and structure. A short shock and a sustained one produce very different outcomes, and right now, forecasters genuinely disagree about which this is. J.P. Morgan has actually lowered its year-end Brent forecast to $78 from a previous estimate of $95, while real-time prices in early August remain elevated on active geopolitical risk. Both can't be fully right at once, which tells you how much uncertainty remains. Second, this shock is landing on an economy that is structurally different from the one that experienced the 1970s oil crises. The story isn't, here we go again. It's a test of whether decades of reduced oil dependence actually change the outcome this time, and early data suggests it does meaningfully. Third, the burden of this shock is not falling evenly, because lower-income households spend a much larger share of their take-home pay on gasoline. An oil shock functions almost like a regressive tax, hitting the households with the least room to absorb it hardest, even as headline economic growth numbers look comparatively stable. Fourth, the resolution in June was real but incomplete. A memorandum of understanding is not a permanent peace, and the events of July, renewed tanker attacks, a refinery strike, Iran's rejection of further direct talks, are a reminder that reopening a choke point doesn't eliminate the underlying risk of it closing again. This is where the headline becomes misleading. What most people are watching is the price of a barrel. What they should be watching is whether the underlying conflict is actually resolved or simply paused. 9. 3 possible futures. Scenario 1. Base case. Prices stay volatile but range-bound through the rest of 2026, oscillating with each new headline out of the Gulf, without a full return to either the April peak above $120 or the July lows below $70. The Fed continues its cautious wait-and-see approach, and the economy absorbs a modest but real hit to growth, broadly consistent with the Chicago Fed's estimated range. Scenario 2. Bullish case for stability. Diplomatic efforts hold. The Strait of Hormuz stays fully open, and OPEC+ production increases help rebalance supply. Prices drift back toward the EIA's July forecast of a $74 average for the third quarter, easing inflation pressure and giving the Fed more room to consider rate cuts later in the year. This scenario depends on the interim agreement holding, despite the tensions already visible in July. Scenario 3. Bearish case. Renewed attacks near the Strait of Hormuz or a full breakdown of the ceasefire push oil back toward or above the April highs. Sustained prices near $130, the level tested in the Atlanta Fed's business survey, would risk meaningfully higher costs for firms, a deeper squeeze on lower-income households, and a much harder set of trade-offs for the Federal Reserve between fighting inflation and supporting growth. None of these are certainties. They are the boundaries of what current data and expert analysis suggest is plausible. Visual, three-path branching chart radiating from the current price range. 10. The bigger picture. Zoom out, and this becomes a story about a vulnerability the modern world prefers not to think about. Global commerce is built on the assumption that energy is reliably available and that key transit routes will always stay open. The Strait of Hormuz closure in February 2026 was a sharp reminder that this assumption is not guaranteed. It rests on a fragile peace in one of the most contested regions on Earth. At the same time, this episode is also a story about adaptation. The U.S. economy of 2026 is measurably less exposed to oil shocks than the economy of 1979 because of decades of efficiency gains and a slow but real shift toward alternative energy. That shift is now visibly accelerating in response to this very shock, in vehicle sales, in travel patterns, and in household energy choices. The deeper tension is this. The world is simultaneously more resilient to oil shocks than ever before, and still fundamentally dependent on a small number of geopolitically unstable choke points for a resource nearly every economy still needs. Both of those things are true at once. Visual split screen, a 1970s gas line photo-style scene fading into a modern EV charging station. 11. Final takeaway. So why does this matter, beyond the price at the pump? Because this shock is a live test of something economists have debated for years, whether decades of reduced oil dependence have actually changed how vulnerable the American economy is to a crisis in a region thousands of miles away. So far, the early evidence suggests, partially, yes. But partial resilience is not full immunity. The Strait of Hormuz can close again. The ceasefire can break down further, and the households with the least cushion will feel it first, regardless of what the headline growth numbers say. The price of oil will keep moving with every new headline out of the Gulf. What's worth watching isn't just where that number lands. It's whether the world's most important shipping lane can stay open long enough for the volatility to finally settle.